QQQ fell harder at 35%. But here's the twist. It recovered faster and crushed OEF's 3-year returns by nearly 30%. QQQ's crushing it with a massive 136% 3-year return. That's a 28-point victory lap over OEF's performance. But here's where it gets interesting. OEF's 108% return over 3 years is solid, but it's trailing behind the leader we're comparing it against here. In plain English, QQQ's racing on the high-speed track here, crossing the finish line a solid 28 points ahead over 3 years. It's like watching a Formula One car leave the competition in the dust. Over 5 years, OEF delivered a solid 114% return. Patience really pays off when you're looking at the bigger picture here. Here's where the story takes a turn. QQQ's 104% 5-year return sounds solid, but here's the kicker. It actually lagged compared to longer periods. Let's break this down further. Over 5 years, OEF's 114% return beat QQQ's 104%. Proof that time horizon totally flips the winner. In plain English, think of QQQ and OEF as marathon runners with different pacing strategies. QQQ sprints early with aggressive growth, while OEF maintains steady, consistent speed to win over longer time horizons. Now for the real question. QQQ's 21% 1-year return shows tech's been flexing its muscles lately. Solid gains powering this tech-heavy contender forward. Let's dig into the details. OEF matched the returns at 20%, proving different holdings can deliver identical performance over the same time frame. Here's where things get revealing. Over the past year, these two funds are neck and neck. QQQ's 21% barely edges OEF's 20%. In plain English, over 1 year, these two performed nearly identically, like horses crossing the finish line neck and neck. Short-term results, basically a tie, making it tough to pick a clear winner here. But wait, there's more to this story. Returns alone don't tell you enough. You need to see how much risk each fund took to deliver those gains. Here's the thing, though. QQQ's 1.4 Sharpe ratio means you're getting solid returns without taking on crazy risk. That's a pretty efficient trade-off over 3 years. Let's take a closer look. OEF matches perfectly with that 1.4 Sharpe ratio. Identical risk-adjusted returns over 3 years. Both funds deliver the same efficiency here. In plain English, think of Sharpe ratio as your investment report card. It measures how much return you're getting for the risk you're taking. 2 investments might deliver the same return, but one could be way riskier getting there. But that's not the whole picture. OEF's 5-year Sharpe of 0.7 is solid, lower than its 3-year performance, but still delivers decent risk-adjusted returns overall. Let's see how this plays out. QQQ's 5-year Sharpe of 0.6 shows decent risk-adjusted returns, though slightly weaker performance over this longer stretch. Here's what really matters. OEF's 0.7 edges out. QQQ's 0.6 on risk-adjusted returns. Small margin, but it means you're getting better bang for your volatility buck. In plain English, think of OEF as the more fuel-efficient car engine here. Over the long haul, it squeezes out slightly better returns for each unit of risk you're taking on. Basically, more miles per gallon. But hold on a second. The Sortino ratio is smarter than basic volatility measures. It only counts losses against you, not gains. That's what really matters. Let's unpack this a bit. Quick pause here. What's your prediction? OEF or QQQ wins this battle? Here's the key takeaway. QQQ's 1.9 Sortino ratio shows you're getting solid returns while keeping those nasty downside swings pretty well contained over 3 years. Now let's flip the script. OEF's Sortino ratio also hits 1.9, meaning both funds manage downside risk identically over the 3-year period. In plain English, downside protections like race cars with different engines. Both hit the same speed over 3 years, but one handles the rough patches way better when the track gets bumpy. Let's get into the weeds here. A Sortino of 1.0 means you're getting solid downside protection, decent balance between returns, and avoiding those painful drops when markets fall. Now let's shift gears and look at QQQ's 0.8 Sortino. Tells us it offers weaker downside protection compared to OEF, less cushion when markets drop sharply. But here's where it gets interesting. OEF's downside protection score of 1.0 beats QQQ's 0.8, meaning you'll lose less when the market crashes hard. In plain English, think of OEF like a race car that accelerates faster the longer you hold the gas pedal down. Over 5 years, that sustained acceleration really compounds. You're not just going fast, you're building momentum. Volatility is your roadmap to risk. Higher means buckle up for wild swings. Lower means you're cruising steady toward your goals. Here's where the story takes a turn. QQQ's 20% volatility is the trade-off for betting big on tech. You'll feel every swing when the sector moves. Let's break this down further. OEF's 16% volatility over 3 years shows you're getting a relatively stable ride. Broader diversification really does smooth out the bumps. But what about QQQ's 20% volatility versus OEF's 16%? Means wilder daily swings. You'll need nerves of steel for this bumpier ride. Here's the tale of two ETFs. QQQ crushes short-term with 136% over 3 years. But OEF's steadier approach wins the 5-year race at 114%, with smoother, lower volatility returns along the way. In plain English, QQQ's like riding a wilder roller coaster. Those drops hit 25% harder than OEF's over 3 years. More thrilling climbs, but buckle up for steeper falls when markets turn south. Here's where things get revealing. Over 5 years, QQQ's volatility hits 23%. Those wild swings get magnified over longer time frames, amplifying both gains and losses. Now let's put this in perspective. OEF's 5-year volatility sits at 18%, smoother than QQQ's wild swings, but rougher than its own 3-year stretch. But wait, there's more to the story. OEF's 18% volatility versus QQQ's 23% means smoother rides and fewer sleepless nights worrying about your portfolio's wild swings. In plain English, stability's like tightrope walking at different heights. OEF keeps its rope closer to the ground throughout the entire walk. Less dramatic, but you're not risking a terrifying fall either. Let's take a closer look. Maximum Drawdown reveals your worst nightmare scenario, the deepest loss you'll endure before things turn around if they ever do. Now here's where it gets tricky. QQQ's worst drawdown hit 35%. That's watching over a third of your portfolio vanish when tech crashes hard. But that's not the whole picture. OEF's worst drawdown hit 26%. That's 9 percentage points less pain than QQQ during the same brutal stretch. Let's see how this plays out. OEF's 9 percentage point advantage in drawdowns means you'll sleep better when markets crash. 26% versus 35% pain. In plain English, here's where storm brewing tells the story. QQQ's volatility packs 35% more punch than OEF is. Think hurricane force winds versus a strong gale. Higher risk, bigger swings both ways. Now let's connect the dots. Recovery speed determines your real opportunity cost. The longer you're underwater after a crash, the more you're missing out on elsewhere. But hold on a second. QQQ took 405 days to bounce back. That's over a year of your money just sitting there, waiting to break even. Let's unpack this a bit. OEF took 421 days to recover, slower than QQQ, despite losing less. That's the downside of lower momentum and rebounds. In plain English, think of healing time like racing athletes. Both stumble hard, but QQQ bounces back and crosses the finish line 16 days faster, even after taking the worst fall. Resilience matters. Now let's flip the script. When funds perform wildly differently, it's not magic. It's where they're putting their money. Sector weights tell the real story here. But there's a catch. QQQ's loaded with 53% tech stocks. That pure concentration's driving both massive returns and wild swings in your portfolio. Let's get into the weeds here. OEF holds 40% in tech. Still heavy, but way more balanced than QQQ's 53% concentration in the sector. In plain English, here's how concentrated your investment really is. QQQ packs 53% into tech, like getting a pizza that's mostly pepperoni. OEF spreads risk more evenly across sectors. But here's where it gets interesting. QQQ's financial services exposure is practically non-existent at just 0.31%, almost zero traditional bank risk in this portfolio. Let's zoom in on this. OEF keeps just 12% in financial services. They're spreading risk across sectors instead of loading up on banks and brokerages. But here's where it gets interesting. OEF has got 12% in financials, while QQQ barely touches them at 0.31%. That's 39 times less exposure, explaining their different volatility profiles. In plain English, here's the egg basket truth. QQQ's stacking nearly everything in tech, so you're riding one sector's fortune. OEF spreads the risk across different industries, giving you real diversification. Let's break this down further. Mid-caps bring a different growth dynamic to your portfolio. It's about diversification beyond just large-cap exposure here. Here's where things get revealing. QQQ isn't all mega-cap tech. 12% sits in mid-cap stocks, giving you some diversification beyond the giants. Now for the real question. OEF barely touches mid-caps at 1.6%. This fund's heart is squarely in large-cap territory, no diversification here. In plain English, think of it like construction rising. QQQ's got a mix of mid-rise projects alongside the towers, while OEF, it's nearly all skyscrapers, focusing on the biggest companies out there. Here's where things get revealing. Both charge 0.2%. Identical fees mean you're choosing based on liquidity, performance, and how well they track the index. In plain English, fee equality means you're paying the same price either way. So which ETF you choose comes down to where you're headed, not what it costs to get there. But wait, there's more to this story. So which one's for you? QQQ. If you're chasing maximum tech growth, OEF, if you want steadier, balanced returns. In plain English, think of it like a road trip. QQQ is the mountain highway with breathtaking views and white-knuckle drops, while OEF is your steady interstate cruise with predictable exits and smooth sailing. Let's take a closer look. The legal fine print. Do your homework, talk to pros, and own your decisions. Now here's where it gets tricky. If you love this ETF showdown, hit subscribe. We're dropping weekly battles just like this, all backed by real data.